Is a $7 trillion wall of cash about to crash? And what does that mean? Find out on this edition of the Video Market Update. By many estimates, there are about $7 trillion of cash that are sitting in money markets and high yield savings and equivalent investment vehicles right now. As you can see on these two charts, you can see the rapid increase of money, what we call sitting on the sidelines, and you can see the reason why, because of the increase in interest rates. Think back to 2022 when you could get a government issued treasury bond, an I-bond, at 9%, or a certificate of deposit at 5.5%, or a money market high yield savings account at 5%. That was driven by an increase, and a very quick increase, in interest rates. And so that's allowed people to take that money, park it into what's considered to be a safer investment, and still earn a return commensurate to their expectations. Well, with an impending Federal Reserve cut in September, and by all indications it looks like there will be an interest rate cut in September, and with pressure to cut in December and then a few times in 26, it looks like those attractive rates of return are possibly coming down. And so it begs the question of, well, what is going to happen with all of this cash that's sitting in money markets and other investment vehicles? If you remember, after the financial crisis, in an effort to try to stimulate the economy, interest rates were cut to zero and stayed at zero for more than a decade. And that caused people to say, well, I can't get any good returns at my bank. None of these fixed investments are doing much. I guess I will go into a riskier, more volatile stock market. And that drove markets higher. But as rates for safer money became more attractive, a lot of money either came out of the market or never went in, because you could get a decent return, a modest return, in a money market or a CD or something to that effect. So the question will be, as interest rates go down and rates go down, what will happen to this $7 trillion of cash? I think most analysts believe two things are going to happen. One, people are going to say, I am okay getting no return. I'm okay letting that money sit there in cash, earning very little. Now, is that sustainable long term? I guess it depends on each investor. The other option is that money's going to go into stocks, bonds, mutual funds, exchange traded funds, and other investments to try to chase yield or to get a higher rate of return above inflation, above tax, again, to what is your expectation. So if that's the case and that money rushes into the market, it could provide for some pretty good growth in the stock market over the next 3, 6, 12 months. It just is going to depend on how fast rates get cut and the willingness for people to let money sit in the sideline versus trying to capture a return in the stock market. So I thought it was an interesting note when we see the amount of cash and then the expectation of, well, what should I do with it? And again, that is up to your individual situation of how best to deploy that cash. If you have questions on this or anything you're seeing in the market, let me know. But if not, as always, I hope you make it a great week.